proprietary ratio is given in quotient, it is 0.8:1. Now, can you tell me what does it mean?
Yeah. So that 0.8 is the total. No, so the 0.8 is the equity of the firm, and then 1 is the total assets.
Okay, 0.8 is our equity. Okay, so our shareholder fund, that is equity. Shareholder fund is shareholder fund is 0.8. Or if we take amount here, let's say 80,000. And our proprietary ratio, total assets is 1. It means how much amount we have to take here? 1 lakh. Then it will be 0.8:1. Is this clear?
Yes, sir.
Okay. Now, the first question is, we have taken a loan from SBI. Yes, yes. Obtained a loan of 5 lakh from State Bank of India. So it will increase our shareholder fund or not? Increase or decrease?
So increase.
Obtained a loan. Loan of rupees 5 lakh. Okay, so actually there is no impact on shareholder fund. If you take a loan from bank, then it will increase your liability, not your shareholders fund.
Yes, sir.
Okay, so there is no impact on shareholders fund. So shareholder fund amount will not change. It will be same. And your total asset will increase, because if you take a loan from bank, the loan will be in cash or bank form. Okay, so it will increase your current assets, which is part of total assets. So our total asset will increase by 5 lakh. Increase by 5 lakh. Actually, the amount is more than the actual this amount. So we should take 8 lakh and 10 lakh here. 8 lakh and 10 lakh. Okay, so now shareholder fund will remain same and your total asset will increase by 5 lakh. So your total asset will become 15 lakh. So now tell me, what will be the impact on the ratio?
So it will decrease.
It will decrease. Very good. Because our numerator is same and denominator increased. So the ratio will decrease here. Okay.
Yes, sir.
Is this clear? Ritika, Vanisha, both of you?
Yes, sir.
Good. Now, the second question is saying that purchased a machinery of 2 lakh by check. So if you purchase a machinery of 2 lakh by check, what will be the impact on balance sheet items? which item will be impacted by this transaction?
So assets will increase.
Okay, and asset will increase, and there will be two effect on items of balance sheet, because every transaction has two effects, dual aspect concept. Okay, actually the first item is machinery. It will increase by 2 lakh, and the second item is cash or bank balance. It will decrease by 2 lakh. Yes.
Yes, sir.
Is there any effect on shareholders fund?
No.
No. And is there any effect on total asset?
No, sir.
No, because one asset is increasing and the second is decreasing with the same amount. So there will be no impact on the ratio. Okay.
Yes, sir.
You understood how to solve these type of question? The third is redeemed 7% redeemable preference share 3 lakh. Okay, so we have redeemed preference share of rupees 3 lakh. Now, can you tell me the impact of this on our ratio? And you don't have to do this actually. This is my working. You don't have to do this part. You have to write that first your answer, that it will increase, decrease, or there will be no change. And then you will write the reason that shareholder fund will remain same and the total asset will increase. So the ratio will decrease. Okay, like this you have to write it.
Okay, sir.
Okay. Now the third question is redeemed 7% redeemable preference share of rupees 3 lakh. What will be the impact on ratio? Can you do it now?
Yes, sir.
Okay, try it. And after that, if you are not able to solve it, I'll redeemed, issued, and actually last three transactions are related with shareholders fund. So should I solve any one of these or whole question?
So what?
Should I solve any one of these 3, 4, and 5 number transaction or whole of the question?
So could you solve the fifth one?
Fifth one.
Yes, sir.
Yes, redeemed 10% redeemable debenture of rupees 6 lakh. Okay, so debenture is categorized as non-current liability. This is a long-term liabilities for the firm, for the company. Okay, so if you are redeeming 6 lakh, redeeming your debenture of rupees 6 lakh, then you are paying their money back. Redeeming means you are paying their money back. So debenture will decrease. So it is long-term liability. It will decrease and our asset will also decrease. Okay, so the ratio will increase. Is this clear?
Yes, sir.
Okay. So question number 3. What will be the impact?
So the preference shares will decrease.
Yes.
Preference shares will decrease by 3 lakh.
Actually, there is some background noise. So can you repeat?
So preference shares will decrease.
Preference share will decrease. Okay. And Vanisha,
So,
you are getting the concept.
yes, sir.
So can you tell me what will be the impact of third transaction? The question number 2 in your previous class homework, and the point number 3, transaction number 3. Redeemed 7% redeemable preference share. You are doing it, Ritika, or
So both preference shares and assets will decrease.
yes? Very good.
So the ratio will also decrease.
Ratio will also decrease. The impact on shareholder fund will be decreased by 3 lakh, that is 5 lakh, and total asset is 7 lakh. So the ratio will be 5 lakh divided by 7 lakh. Yes, it is 0.714. Yes, ratio will also decrease. Very good. And the point number 4 is issued equity share to the vendor of building purchased for 7 lakh. Now you have issued shares, so it will increase your shareholder fund, and you purchased a building of 7 lakh, so it will increase your total assets by 7 lakh. So there is same effect on both sides, increase of rupees 7 lakh in shareholder fund and increase of rupees 7 lakh in total assets. So what will be the impact?
So shareholder fund will increase, but there will be no change in the total assets.
There will be no change. Yes. There will be no change. Actually, the ratio will increase. Ratio will increase because if our, let's say, shareholders fund equity was 8 lakh and now there is an increase of 7 lakhs, so total equity will be 15 lakh, and total assets in the past it is 10 lakh and now it is plus 7 lakhs, so total 17 lakh. So you will get 15 divided by 70. Okay, 0.88 is to 1. So increase. Okay.
So when we are purchasing the building, won't asset and sorry, the cash and building be of the same value? So how is
No.
asset increasing?
We are purchasing our asset not by cash. We are issuing equity share in return.
Okay, sir.
Okay. So that's why shareholders fund is increasing, not cash is not decreasing.
Okay, sir.
So this is your question number 2. Any other doubt in previous class homework?
No, sir.
Okay, there are some questions which is related to interest coverage ratio. Have you tried those questions?
So I couldn't complete all the questions. I did only few of them.
Okay. So we were talking about interest coverage ratio in our previous class. Yes.
Yes, sir.
Okay. So interest coverage ratio. First of all, what is interest coverage ratio? Interest coverage ratio. Now, generally it is taken as interest on long term. This interest means interest on long term debt. Okay. And for payment of this interest, which amount will be used? Actually, we pay interest from our profit. But if there is no profit, then also we have to pay the interest. Okay. But this ratio shows the relationship between interest and profit to pay that interest. Okay. Because if we have enough profit, then we are able to pay our interest. So the bank or financial institution wants to know that we are earning sufficient profit for payment of interest or not. Okay.
Yes, sir.
Okay. So the objective of calculating interest coverage ratio, that we are able to pay our interest or not in future or in present, obviously. So the formula for interest coverage ratio is interest coverage ratio equals to net profit before interest and tax before interest and tax divided by interest on long-term debt. Interest on long-term debt. Now, why we are taking net profit before interest and tax and not profit after tax? Can you tell me?
So because net profit after interest and taxes, the value it is after deducting the interest and tax rate. So if we are comparing, I mean, for the ratio, if we take that, then it's not appropriate to calculate the.
Yes, yes, very good. Actually, net profit after tax, okay. In this profit, we have already deducted our interest on long-term debt and also tax, okay. So that profit is not available for debenture or loan. That profit is available for equity shareholders and preference shareholders. So if we have to compare the net profit after tax, then we have to use the dividend or earning per share. Okay, in that calculation, we will use net profit after tax. So we are using net profit before interest and tax because this profit is available for payment of interest. Okay, we are paying our interest from net profit before deducting interest. That's why we are using net profit before before interest and tax. Now, if question has information about net profit before interest and tax, then it is fine. But generally, they will give you the information about net profit after tax. As I told you in previous class, yes, you will be
Yes, sir.
given this amount. Now, it is after tax. So first, you have to add tax in this. And tax rate will be given in the question. So you have to calculate tax, not on this amount. you have to calculate tax differently by using a formula. Okay, so tax, let's say whatever the rate, at the rate 30% or 40%. So you have to add tax. Then you will get profit before tax. And in profit before tax, add the interest. So this is your profit before interest and tax. Profit before interest and tax. So this is how you will calculate your profit before interest and tax. Now, interest amount will be calculated on the long-term loans or debenture. It is given in the question, so you will calculate this. But tax is to be calculated on profit before tax, and you don't know this amount. This tax should be calculated on this amount, but you don't know this amount. You will be given this information. Okay, so in that case, what we have to do, we will calculate tax like this. Tax equals to, if we have to use profit after tax, then profit after tax multiplied by rate divided by 100 minus rate, means rate of tax. Rate of tax. So you will use this formula. Now, why we are doing 100 minus rate of tax? Because profit after tax is after deducting rate of tax from profit before tax. So we need tax. Okay, we need this amount as profit before tax. Okay, so that's why we have deducted 100 minus rate of tax. Then it will be equal to this amount. Okay, like if your profit before tax is 100%. Okay, and you are deducting tax rate of 20%, so you will get 80%. So your profit after tax is equal to 80%. That's why we are deducting this. So we will get profit after tax equal to 80%, and the tax will be calculated correctly. So this is how we will calculate interest coverage ratio. Okay, is this clear?
Yes, sir.
You have taken the screenshot.
Sir, I wrote it down.
You can see this is the definition or objective of interest coverage ratio. It shows the relationship between net profit before interest on tax and interest on long-term debts. It is calculated to ascertain the amount of profit available to cover interest on long-term debt. So this ratio is good if it is higher. Okay, so let's say it will be calculated in times, like 2 times, 3 times. So it will tell us that our profit is in multiple of interest payable. Okay, and the higher the ratio, it is good for our company and also the loan provider. So high ratio indicates higher profit margin to pay interest on long-term debt, and low ratio means insufficient or low profit to cover the interest. So this is your interest coverage ratio. Is there any doubt?
No, sir.
So let's try to solve some question here. Okay, so for interest coverage ratio, you can see here the question is given. Question number 61 is simple. We have to just divide the net profit before interest and tax and interest. So, okay, so we will solve question number 63 or 65. 65 is full question. Or is there any other part on the next page? Definition. No, it is full question. There is no other part left here. Okay, so question number 65. From the following information, calculate interest coverage ratio, 10,000 equity share of 10 each, 8% preference shares, 70,000, 10% debenture, 50,000, long-term loan from bank, that is 50,000, interest on long-term loan from bank, 5,000, net, actually tax is given in the portion. 9,000 net profit after tax, so 75,000 plus 9,000 and plus 5,000. It is not the question here. So question number 64. Leave question number 65. Question number 64. From the following information, calculate interest coverage ratio, net profit after interest and tax, 1,20,000. Yes, this is our question. Question number 64, actually, solution. So net profit before interest and taxes given. Net profit before interest and net profit before, not after, okay, after, sorry. Net profit after interest and taxes given. After interest and tax, the amount is 1,20,000. So 1,20,000 here. Now we will add tax here. Tax rate is given in the question. It is 40%. Okay. So tax at the rate 40%. Now, can you calculate the amount of tax for me?
Yes, sir. So 80,000.
80,000.
Yes, sir.
Okay. Vanisha, have you tried to calculate this?
Yes, I'm doing.
Yes.
Yes, I'm doing.
Okay. 80,000. Your answer is correct, Vanisha. Yes. You have to calculate 1,20,000 into 40 divided by 100 minus 40. That is 60%. So you will get here 80,000. So this is your 2 lakh. Profit before tax you get. Now we have to add interest here. Interest. So what is the amount of interest here? You can see the 15% debenture of rupees 1 lakh and 12% mortgage loan of rupees 1 lakh is given. So what will be the interest? 1 lakh into 15% for debenture and 1 lakh into 12% for mortgage loan. So total interest will be 27,000, 15,000 plus 12,000. It is 27,000. 15,000 plus 12,000. It is 27,000. So the total amount is 2,27,000. Okay, this is your profit before interest and tax. If profit before interest and tax is given in the quotient, then you don't have to do this calculation. You just have to calculate interest coverage ratio. Interest coverage ratio. So the formula for interest coverage ratio is profit before interest and tax divided by interest and tax divided by interest on long-term debt. So the amount will be 2,27,000 divided by interest on long-term, that is 27,000 we get. So the ratio will be 2,27,000 divided by 27,000. So we get 8.40 or 8.41 times. Okay, so this is the solution of interest coverage ratio. Do you have any doubt in this question?
No, sir.
Okay. Vanisha,
No, sir. I'm doing.
okay. So this is your fourth ratio in solvency ratio. So the first one was debt equity ratio. The second is total asset to debt ratio. Third is proprietary ratio. And fourth is interest coverage ratio. There is one more ratio we have, which is debt to capital employed. Debt to capital employed. Now, can you tell me what is capital employed meaning? What is capital employed means? Please tell me, Ritika.
So it's the capital invested in the business.
Okay. This is just a definition. Can you tell me what we have to include in capital employed? What are the items that is to be included?
So I'm not sure.
Okay. Okay. So capital employed means long-term capital invested in the business. It includes shareholder fund and non-current liabilities. Okay. So long-term borrowing, long-term provisions, shareholders fund, equity share capital, preferential capital. These are our capital employed. So if you deduct current liabilities from total assets, then you will get your capital employed. So now this ratio tells us that how much money we have borrowed, okay, in comparison to total capital employed. Okay, the first ratio was debt to equity ratio, means we were comparing our long-term debt with equity shares. Okay, but capital employed include both of these, shareholders fund and long-term debt. Okay, so we are comparing our long-term debt with the total of shareholders fund and long-term debt. Okay, so the formula for debt to capital employed ratio is long-term debt divided by capital employed. Capital employed. So now what does it mean by capital employed? So capital employed equals to total assets minus current liabilities. Or if you go by liability side, then it will be shareholders fund plus long-term debt. Okay. So by this, you will know that how much percentage of total capital employed is from long-term debt. Okay. So this is our debt to capital employed ratio. Actually, in my book, it is 2 years old. That's why there is no portion of debt to capital employed. I think there will be some portion in your book. Yes. Can you see your book?
Yes, sir, there is.
There are some questions related to this.
Yes, sir.
Okay. So can you just try to solve those questions, okay, and take the picture of that questions and send me in next class. We will discuss those questions. Okay.
Okay, sir.
Okay. Now, after this, yes, after interest coverage ratio and debt to capital employed, there is a concept of activity ratio. Okay, so activity ratio is related to efficiency of business. When we talk about activity ratio, it means that our work is efficient or not. Okay, so there are some activity, some ratio included in this activity ratio is inventory turnover ratio, debtor or trade receivable turnover ratio, creditors or bills payable turnover ratio, average collection period, working capital turnover ratio, or you can say total asset turnover ratio, fixed asset turnover ratio, or current asset turnover ratio. Actually, there are fixed asset turnover ratio and current asset turnover ratio is not included in your syllabus, I think. So you have to study only working capital turnover ratio and total asset turnover ratio. Okay. Net asset turnover ratio. Yes. Net asset turnover ratio it is. Okay. So what activity ratio tell us is that how we are performing in each of these area. Like if we have inventory, how much time it takes to convert into sales. Okay, cost of goods sold. So the item we are selling, we convert our inventory in cost of goods sold and then we sell it. So how much time we take for converting inventory into our cost of goods sold. So if time taken is less, then it is good for us. Okay, so this is our inventory turnover ratio. I'm just giving you overview of the activity ratio. The second is trade receivable turnover ratio, means how much credit sale we done in a year, and from that credit sale, how much is unpaid at the end of the year. Okay, so we are not able to collect that amount. So we compare these two data for calculation of trade receivable turnover ratio. In this trade receivable turnover ratio, there is a ratio attached with it. It is called average collection period. Means how much time we take to collect our debtors, collect money from our debtors. So this is called average collection period. Now, in the same manner, there is trade payable turnover ratio and average payment period. Means how much credit purchase we have done in a year, and at the end of the year, how much is unpaid. Okay, so we compare these two data to calculate trade payable turnover ratio. Now, in trade payable and trade receivable, actually two items are included. In trade receivable, debtors and bills receivable is included, and in trade payables, creditors and bills payable is included. Okay.
So could you repeat?
Okay. In trade receivable, debtors and bills receivable is included. And in trade payables, creditors and bills payable is included. Okay.
Yes, sir.
Okay. Now, the next ratio is working capital turnover ratio. Can you tell me what is working capital?
So working capital is used for the day-to-day activities of a business.
Yes, working capital is used for day-to-day activity of the business. Yes. So the formula for calculating working capital is
The current assets minus current liabilities.
current assets minus current liabilities. Very good. So we have to calculate working capital turnover ratio also. Now, what is cost of goods sold? Cost of goods sold. Do you know cost of goods sold?
Yes, sir, but I don't know how to explain it.
You know the formula of cost of goods sold?
Yes, sir.
Vanisha?
So cost of goods sold is the cost of revenue from operations, right?
The formula. Okay, no problem. So cost of goods sold It means the goods which are sold. So we have to calculate cost of those goods. Okay, so cost of goods which are sold. Now, what is the formula of cost of goods sold? So it is opening stock, because in activity ratio you need cost of goods sold. That's why I asked. So opening stock plus purchase, net purchase, you can say net purchase, plus direct expenses minus closing stock. Okay.
Yes, sir.
So now you remember. Actually, you have studied 3 to 4 times this formula. You have used this formula in many of the chapter. Do you remember this? No? Yes, Ritika.
So I think we have only used this once last year in one of the
Last year
chapters. Yes,
in
sir.
financial statement.
Yes, sir.
Okay, so this is our cost of goods sold. Actually, we have used in single entry system and also in NPU. No, there is no cost of goods sold in NPU. Okay. In NPO, you have studied cost of material consumed. You have completed your NPO, non-profit organization.
No, sir.
Okay, that's right. Okay, so cost of goods sold formula. Now, there are certain formula in which we will use revenue from operation. Do you know about this word, revenue from operation?
Yes, sir.
What is this? Revenue from
And
operation.
net sales.
Net sales, yes. Yes, Vanessa, you were saying something?
Sir, I take it.
Okay. So revenue from operation is net sales. Now, in some of the formula of, in some of the ratio, activity ratio, you have to use revenue from operation. And in some of the ratio, you have to use cost of goods sold. Okay. But if there is no information about one, then you can use other. Okay. So let's say the formula says we have to use cost of goods sold, but there is no information in the quotient about cost of goods sold, and we cannot calculate cost of goods sold. Okay, so in that case, we have to use revenue from operation if it is given in the quotient. In the same manner, if revenue from operation is to be used in the formula and it is not given and cannot be calculated, then we will use cost of goods sold. Okay, there is one more formula for calculating cost of goods sold. It is net sales minus gross profit. Okay.
Yes, sir.
Okay. So, do you remember trading account that you have prepared at the time of final account? Yes, in 11th. Do you
Yes, sir.
remember? Okay. So, what are the items that is credited and debited in trading account?
So direct expenses and direct incomes.
First, we start our trading account with opening stock.
Yes.
Then Then net purchase means purchase minus purchase return. We have to write that amount, and then wages, carriage, like all the direct expenses. After that, on the credit side, there is sales, net sales, and closing stock. Okay. So the amount we calculated there is gross profit. Yes.
Yes, sir.
So if you see opening stock on the debit side, purchase on the debit side, and direct expenses on the debit side. There is sales on the credit side and closing a stock on the credit side. Yes.
Yes, sir.
So if you remove this sales from here, then you will get your cost of goods sold formula: opening stock plus purchase plus direct expenses minus closing stock. This is your cost of goods sold. And if you deduct all of these from sales, then you get gross profit. Is this clear?
Yes, sir.
Okay. So this is your cost of goods sold. Now, the first ratio is inventory turnover ratio in activity ratio. Okay. Actually, yes. Yes, activity ratio. You can see here, it is also called performance or turnover ratio, means it is used for calculation or for seeing the performance of the company. Okay, it measures efficiency of enterprise in utilization of its resources. Generally, these ratio are expressed in times. Activity ratio are okay. So activity ratios are inventory turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, working capital, average collection period, average payment period. Okay, there is net asset turnover ratio also included in syllabus in this year. So these are the ratio we will use to calculate the efficiency of our business. Now, first item, inventory turnover ratio. It established the relationship between cost of revenue from operation or cost of goods sold, you can see here, and average inventory during the period. Now, you know how to calculate average. Yes.
Yes, sir.
Okay. So if we have to calculate the average inventory, then what will be the formula for calculating?
So opening inventory plus closing inventory divided by 2.
Okay, so you can see here inventory turnover ratio formula, cost of revenue from operation divided by average inventory. Average inventory equals to opening inventory plus closing inventory divided by 2. Okay, we will discuss this actually in detail in our next class. Okay, until then you have to you please try to solve all the portions of solvency ratio. Okay.